What's up? It's Lucky. Today we're talking about something that connects how you run a business, how you invest your money, and why the people paying attention right now are going to build generational wealth. It's called velocity, and most people completely underestimate what happens when you speed it up. We just published an article about how AI changed the velocity of our business. The idea is simple. When you go from iterating on a strategy once a quarter to iterating every hour, the compounding effect is staggering. You learn faster, adapt faster, ship faster. The gap between you and someone still stuck in quarterly planning cycles becomes exponential. But here's the thing. That same principle applies to your money. Velocity of money is an old concept, but it's getting a brand new upgrade. The idea is straightforward. How fast does your capital work, get returned, and go back to work again? Historically, dividends paid quarterly. Your money sat around for 3 months before it could compound. But what if it didn't have to wait? What if your dividends hit twice a month? Or every single day? Two things just happened that nobody's talking about enough. Strategy Incorporated, Saylor's company, proposed moving their STRC preferred stock from monthly to semi-monthly dividends. That's 24 payment cycles per year instead of 12. And then Strive one-upped everyone. Their SATA preferred stock is moving to daily dividends starting June 16th. Daily, at 13% APR. That is the first security in history to pay dividends every single business day. Think about what that means for compounding. Now, I'm going to be honest with you, because that's what we do here. If you're compounding at the same rate, just increasing the frequency alone doesn't move the needle as much as you'd think. Going from annual to daily on an 11.5% yield turns $297K into $316K over 10 years. That's real money, but it's not life-changing. So why does frequency matter? Because frequency isn't about the rate. It's about what you do with the cash when it hits. And more importantly, it's about the psychology. Here's the problem everyone ignores. Just putting $100K into Bitcoin and holding sounds great on paper. Historically, it averages around 30% annual returns. But here's what the spreadsheet doesn't show you, the gut punch. We ran 1,000 simulations. In every single one, Bitcoin dropped more than 50% from its peak at some point during the decade. In 96% of them, it dropped more than 70%. The median max drawdown was 90%. You know the meme, Bitcoin at 100K, standing room only to buy. Bitcoin at 30K, nobody's in line. That's real. That's human psychology. People buy when they're euphoric and sell when they're terrified. The math works. The humans don't. This is why dividend frequency changes the game. It's not about the math of compounding at the same rate. It's about automating the one thing humans are terrible at, buying when the market is down. When your yield instrument pays you daily, that cash auto-deploys into Bitcoin or the S&P every single day. You don't have to think about it. You don't have to time it. You don't panic sell at the bottom because you're not making lump sum decisions. You're just collecting yield and redeploying it. Daily DCA gives you 2,500 purchase points over 10 years. Quarterly gives you 40. You're catching every dip, every crash, every recovery, automatically. Here are the real numbers. 1,000 simulations, 10 years, $100,000. Daily DCA into Bitcoin. The median outcome is 3.4x your money. Quarterly DCA, 3.2x. Both crush the lump sum investor who gets just 1.8x, because most people can't hold through a 90% drawdown. Now look at the S&P. Daily DCA gives you 3.1x. Lump sum gives you 2.4x. The DCA advantage is real in both assets. And if you blend them, half into BTC, half into the S&P, daily DCA gets you 3.4x with way less volatility than pure Bitcoin. The daily dividend investor doesn't just have better math. They have better psychology. They never make a timing decision. The yield just keeps flowing into the growth bucket. Think of it as a dual-engine model. Engine 1 is yield, STRC, SATA, whatever's paying you consistent, high-rate cash. Engine 2 is growth, Bitcoin, the S&P, high-conviction assets. The yield engine generates the ammo. The growth engine puts it to work through automated DCA. But here's what really makes this smart, and this is the part most people miss. STRC and SATA are what I'd call an and investment. You're getting yield and you still have access to your money. These preferred stocks trade near par, around $100 a share, with very low volatility. If life happens, emergency, opportunity, whatever, you sell the preferred stock and you get your cash back with minimal loss. Now compare that to the person who put everything into Bitcoin. Bitcoin drops 50% and they need cash. They're forced to sell at the worst possible time. They lose half their money. With the dual engine model, you never touch your growth assets in a downturn. The preferred stock eyes your emergency fund, and it's paying you 11 to 13% while it sits there. It's your yield engine, your DCA machine, and your safety net, all in one position. Now zoom out. We started this week talking about how AI compressed months of business work into days. That's velocity of work. Today we're talking about how daily dividends turn volatile assets into reliable wealth-building machines through automated DCA. That's velocity of money. Put them together and you've got something that's never existed before. You don't need a trust fund. You don't need perfect timing. You don't need nerves of steel. You need a yield engine, a growth bucket, and the discipline to let the system run. The lump sum investor only beats the DCA investor 31% of the time, and they have to white-knuckle through 90% drawdowns to do it. The DCA investor, they just collect their daily dividend and let the system work. Speed isn't the edge. The system is the edge. That's the velocity of money. Whether it's your business or your portfolio, the advantage goes to the people who build systems that compound automatically, not the people who make the biggest bets or time the perfect entry or have the most courage, the people with the best systems. As always, not financial advice, just a dog with a cigar and a spreadsheet. I'm Lucky. This is Entrepreneurial Alpha. Go make it happen.